Today I have for you 4 great stocks to buy throughout the month of November. All of them have great dividend safety scores and are trading at a pretty decent value right now. So without further ado, let's jump in. First stock on our list is Pfizer, ticker symbol PFE. Pfizer is one of the world's largest pharmaceutical firms, and historically they've sold many types of different healthcare products and chemicals, but now primarily focus on prescription drugs and vaccines, which makes the majority of their sales. From the start of the year, Pfizer has fallen 16.65%. However, within the last month, it has grown 7.83%, bringing it to a share value of $47.22. It is trading below its midpoint right now, close to its 52-week low, which was $41.45, has a market cap of $265 billion and trading at a PE of 7.33. As far as its dividend, Pfizer has a dividend yield of 3.39%. which will give you an annual payout of $1.60. Their payout ratio is 24.39%, and they have a growth rate for the last 5 years of 5.7%, and have been growing that dividend consistently for the last 12 years. Seeking Alpha gives Pfizer a safety score of B and a growth score of A+, and Dividend Tracker gives them a value of 80. Over on the income statement for Pfizer, first looking at the revenue, we can see here that year over year, the revenue has been growing. It did drop and stayed around that $40 billion. In the last 2 years, it has grown to a current value of $106 billion. Right down here for the net income. For its net income, it did have 2 years it dropped back in 2018 and of course 2020, as many things did. But since 2020, it has been grown since then with a current value of $35 billion. Now looking at its earnings per share, along with their net income, it did drop in 2020 and 2018, just like their profit did. And since 2019, we've pretty much doubled what we had in 2019. Scrolling down once again toward the shares outstanding. Looking here, we want to see if they're buying back shares. Now they did issue some shares back in 2020 and 2021, but since then they have been slowly buying back. So you can see 5.61 billion shares, and now they have 5.59 billion shares. And along with their dividend, they, just like we saw in Seeking Alpha, they have been growing their dividend year over year right down here, which is a good sign. Over on this cash flow, we want to scroll down here to the free cash flow. And how you calculate free cash flow is by taking your cash from operations, which is this line right here, and subtracting your capital expenditures, which is this line right here. Now give you your free cash flow. So the importance of free cash flow allows the company to do 5 different things, which is pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back in the company. So I do want to point out that with the drop in earnings per share and the net income in 2020, Pfizer was able to actually have a bump up in their free cash flow, which is kind of good to see. In 2020, it did jump up a lot, most likely due to all the vaccines. And we have stayed close to that new level, not dropping down to what we had before. So that's a good sign that Pfizer may be able to kind of keep this level of free cash flow going forward. And with that, they have a 5-year average of $18.58 billion. Over on their balance sheet, the first thing I want to calculate is their current ratio, which is the current assets divided by current liabilities. And the reason for this is to determine a company's ability to pay off their short-term debt within a year. And we're looking for a ratio value above 1. So scrolling right down here, we have the total current assets, which is $67.47 billion. And scroll down here to the current liabilities, which is $47.41 billion. So calculating those two, we come to a value of 1.42%, which is good for Pfizer. Next thing I want to look at is their long-term liabilities. So scroll down here, we have long-term liability of $60.41 billion. And we're going to divide that by the 5-year average of free cash flow just to get a determinant of how long it could take them to pay off all of their debt, which calculating the two, we have 60 billion divided by the 18 billion, come close to 3.25 years. It'll take them to pay off all their liability with their free cash flow average. We're looking at the price target, and they're looking for an average price target of $53.91. So that's about 14.17% higher than the current share price right now. Last thing for Pfizer I want to look at is over in TradingView right now. This is a weekly chart. So each of these candlesticks is a week. For Pfizer, we can look down here. We are starting to enter into a positive trend with all this new buying volume right here. The buying value is what's giving us the momentum to continue moving upwards. So looking right here, I want to point out some support levels. And back in March of this year and in June of this year, it's been around that $45 range as a support. And that's pretty much where we're at right now, around that $45, $46 range. So with this positive trend moving upwards, very well we could have enough volume to break through the 25-day moving average, which is this purple line right here, or at least very well stay on this support level of the $45, $46 range. And if not, the next lowest support is around that $40, $42 range. Second stock is Stanley Black & Decker, ticker symbol SWK. And Stanley Black & Decker is a manufacturer of hand and power tools, and the company operates in 3 different business segments, which is tools and storage, security, and industrial. Tool storage sells their different hand tools. They have different security systems, electronic security services, and industrial basically sells different engineering fastening products. For the start of the year, Stanley Black & Decker has fallen pretty much 60%, and over the last month it has fallen 9.5%, bringing them to a current share price of $74.64. So they are pretty much at their 52-week low, which was $70.34. They have a current market cap of $11 billion and are trading at a PE of 17.03. Forward dividend yield is 4.29%, which will give you an annual payout of $3.20. Their payout ratio is 46.82%. And for the last 5 years, they have been growing their dividend at a rate of 6% and have been growing that dividend consistently for the last 53 years, making them a dividend king. Seekonow gives their dividend safety score a B+, with their dividend growth score of a C. And Dividend Tracker gives them a safety score of 66. Over in their income statement, looking at their revenue, you can see that Stanley Black & Decker basically has had the same revenue growth from the last 2 years, but it is higher than their average the last couple years, which is a good sign that they're moving into the right direction. Scrolling on here to the net income. Now, their net income, the same with their revenue, has pretty much stayed the same these last 2 years, but it is higher than their average the last couple years. Looking at their earnings per share, you can see that they did have a jump up in 2021, and they have slightly fallen in this year. However, it is higher than their previous years that were around $6, $4, and $6. So they are higher than they were about 5 years ago. Right then here, looking at share buybacks, and you can see that they were issuing shares as we got into the pandemic, but right now they are starting to buy back shares. So we're at 144 million shares, which is a good sign that they're buying back shares, especially now since their share price is so low towards their 52-week low. It's a good time for the company to start buying back their shares. Now looking at their dividends, just like we saw in Seeking Alpha, they have been growing their dividend year over year, which is, you can see right here, which is great to see. Over in their cash flow, just scroll down here for their free cash flow. And the first thing that sticks out is that right now they are in a negative free cash flow, which is not a good sign for Stanley Black & Decker. Their average the last couple of years been between the $1 and $1.5 billion. So hopefully moving forward, they can get back to that level. So they've been hit pretty hard this last year. And with that, the current 5-year average is $341 million. Looking at their current assets, scrolling right down here, they have $8.8 billion. And scrolling down here to their current liabilities, they have $7.61 billion. So I'll give them a ratio of 1.16. And right down here to their long-term liability, you see they have $8.37 billion. So dividing that by the $341 million of their free cash flow, that'll give them about 24 and a half years to pay off all their liabilities, which is definitely not a good sign. Stanley Black & Decker has a lot of debt on their hands. So one thing to consider with investing in Stanley Black & Decker. With their average share price of $86.87, it is looking at over 16% upside from their current share price. So that is a good sign. So over on TradingView, we can look at right now, we've pretty much been sitting at this $70 range. And the last time we were there, scrolling back here, was in the pandemic. So you see right there, March of 2020. So pretty much the last couple of weeks just been sitting at that level. As far as a trend, we can consider this as a dog stock right now. Next up is Texas Instruments, ticker symbol TXN. And Texas Instruments generates over 95% of its revenue from different semiconductor and well-known calculators that all of us probably have used throughout our school years. And also the world's largest maker of the analog chip. For the start of the year, Texas Instruments has fallen 14.5%. Within this last month, they have fallen 1.23%, bringing them to a current share price of $162.65. They're right below their midpoint with a low of $144 and a high of $199. Their current market cap is $147 billion, and they're trading at a PE of 17.09. They have a current dividend yield of 3.05%. That will give you an annual payout of $4.96. They have a payout ratio of 46.77% and have a 5-year growth rate of 17.22%, which is pretty great, and have been growing that dividend steadily for the last 17 years. Taking off gives Texas Instruments a dividend safety score of A- and a dividend growth score of A+, and Dividend Tracker gives them a safety score of 87. Over on their income statement, looking at their revenue, they have been growing their revenue year over year with pretty much at the same level in 2020 and 2019, which is understandable, and have been growing since then. So they're currently at $20 billion. We're down here for their net income. They have been steadily growing their net income year over year with slight drops in 2020. But needless to say, they have grown back since then to a value of $8.9 billion. For their earnings per share, they have also been growing that year over year, as we can see, which is great to see. And as far as their shares outstanding, they did issue shares after the pandemic, but they are starting to buy them back. So right now, 913 million shares. And as we saw in Seeking Alpha, they have been growing their dividend year over year, which is great to see. Over on cash flow, scroll down here to their free cash flow. And their current free cash flow levels has dropped from last year to around the same levels they had in 2019 and 2018. So it's good to see that they're still kind of managing what they have been historically the last 5 years. And I'll give you them a 5-year average of $6.04 billion. Right in here for their current assets, they have $13.77 billion. And for their current liabilities, that is $2.8 billion. So that'll give them a current value around 4.92%, which is great to see because we're looking just for over 1%. So great to see for Texas Instruments. Scroll down here to the long-term liabilities, we see $8.7 billion. So divided that by the $6 billion of their 5-year free cash flow, we come to a value of 1.5 years it'll take them to pay off all their liabilities. Great to see for Texas Instruments. We have an average share price of $170, so that's about almost 5% upside from the current share price. Over in TradingView, we can see a couple weeks ago they hit their latest support around that $150 range, and since then they have started to bounce back. They are just starting to enter into a positive trend with that red line crossing over the yellow line. So if they continue with this buying volume right now to have that momentum to break through the 25-day moving average, it'll look very good for Texas Instruments, so they continue riding that upwards. And one other thing to notice is that the price they're at right now was another support level back in February of this year and around May, so that 160, 165 range was a support level. So if they can break through their 25-day moving average, they might be able to stay around that level and possibly move upwards if they get enough volume going through. So good to see for Texas Instruments. Moving along, we have Visa, ticker symbol V. So Visa is the largest payment processor in the world, has processed more than $14 trillion and operates throughout 200 different countries. From the start of the year, Visa has fallen 11%, and within this last month, they have grown 6.5%, bringing them to a current share price of $196.98. So they are right below their midpoint with a low of $174 and a high of $235. They have a current market cap of $378 billion and are trading at a PE of 23.78, which is a bit higher than we usually look at because a good value is around 20 or below, of course. Visa has a dividend yield of 0.91%. That'll give you an annual payout of $1.80. They have a payout ratio of 21% and have a growth rate of 17.84% for the last 5 years. And they have been steadily growing that dividend for the last 13 years. So Visa is definitely in that growth stage right there. So keeping it for a long term will be good as far as a dividend growth stock. Seeking Alpha gives Visa a dividend safety score of A and a dividend growth score of A+. Dividend Tracker gives them a safety score of 93. Over on the income statement for Visa, we can see that they have steadily been growing year over year, which is great to see with the current value of $29 billion. Scrolling down here to their net income, and once again, they have steadily been growing year over year, which is great to see. A slight drop in 2020, which is understandable. For their earnings per share, they have been growing that year over year with a slight drop in 2020, But other than that, it's been looking very good for Visa. And after 2020, as far as their shares outstanding, they did issue some shares, but have since then been buying back shares. So great to see. And as we saw, they've been growing their dividend year over year. On their cash flow statement shown on here, looking at their free cash flow, they have been growing their free cash flow. The last couple of years, it's been around that $11 billion range and have pretty much been growing it since then. So great to see with an average, 5-year average of $12.69 billion. On their balance sheet, right down here for their current assets, we have $30.21 billion. And scroll down here to their current liabilities, we have $20.85 billion. So that'll give you a ratio of 1.45%. Right down here for their long-term liabilities, we have $29.07 billion. And dividing that by the $12.69 billion, we come to a value of 2.29 years it'll take them to pay off all their liabilities. With a current price target of $248, that's about a 26% upside from the current share price, which is great to see. And over in TradingView, looking at here, we can see that they are starting to have a positive trend right here, and they have had some buying back with exception of this last week. But they are moving, did break through their 25-day and 50-day moving average. So it looks like they're staying between the two right now. And where they're sitting at that $195 range, has been a support the last couple of months here. So it seems to go up and down, up and down. So very, very well could stay sitting on this 200-day moving average, which is this white line right here. And since we are turning up, we may have enough volume to continue moving upwards. And it looks like from this year, the average had been around that $215 range has been kind of the highest, and $225 range. So if we do move up, most likely not too much higher than the low 200s. If you found value in this content, definitely let me know by smashing that like button and drop a comment down below what your thoughts are about these 4 stocks I went over today. If you're looking for more stocks to consider, check out this video right over here and I'll catch you over there. Have a blessed day. Peace.